This week, Wall Street quietly stopped using one of the most famous investment acronyms of the last 3 years. The Magnificent Seven, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, was the dominant framework for understanding the US stock market since 2023, a handful of mega-cap tech stocks driving most of the market's returns. Now, in mid-2026, an analyst at AllianceBernstein named Julie Gantz went on Yahoo Finance and introduced a new acronym that's now spreading through finance Twitter, ETF marketing decks, and Wall Street research notes. It's called MANGOS, and it represents what Wall Street believes is the next phase of the AI and tech boom. M for Meta, A for Amazon, N for Nvidia, G for Google parent Alphabet, O for OpenAI, S for SpaceX. Notice what's missing: Apple, Microsoft, Tesla. Notice what's added: 2 of the biggest names aren't even publicly traded. OpenAI and SpaceX are still private companies. So today I want to do something different. Instead of just cheerleading this new acronym, I'm going to honestly evaluate it. What does MANGOS actually represent? Is it a real investment thesis or just rebranded hype? What does the historical pattern tell us about narrow market leadership concentrated in a handful of names? And to ground this, I'm going to pair this current market story with one of the most respected investing books ever written, Common Stocks and Uncommon Profits by Philip Fisher. Warren Buffett famously said he is 85% Benjamin Graham and 15% Philip Fisher. Fisher's framework is the entire basis for concentrated, high conviction investing in great companies. So the question is, does the MANGOS basket actually fit Fisher's framework? Or is it the kind of crowd-driven story he would have warned against? Welcome to Earnings Per Page. Honest finance, no hype. Hit subscribe. Let's get into it. First, let's break down what's actually changed. The Magnificent Seven was coined in 2023. It made sense at the time. 7 mega cap tech stocks were carrying the entire US market. But in 2025 and 2026, the cracks started showing. Apple's growth slowed dramatically as iPhone sales plateaued. Microsoft's AI cloud growth started to disappoint. Tesla's stock got disconnected from its actual business performance. Meanwhile, 3 names quietly took over the AI conversation. Nvidia, which had already become the most valuable company in the world for periods of 2025. Amazon, whose AWS business became the backbone of enterprise AI deployment. Meta, whose AI investments started producing genuine revenue. And critically, 2 private companies started dominating finance conversations as much as public ones. OpenAI's valuation soared past $300 billion in private markets. SpaceX valuation rose above $350 billion. Both companies are now larger than the vast majority of public companies. So when Wall Street built the new MANGOS acronym, they made a controversial choice. They included 2 private companies. Investors in regular index funds and ETFs can't easily buy OpenAI or SpaceX shares. Only ultra-wealthy investors with access to private markets or specialized ETFs that hold pre-IPO shares get exposure. This is the first thing to understand about MANGOS. It's not really a stock picker's acronym. It's a market narrative, a way for analysts and ETF marketers to describe where they believe value is concentrating, even when most retail investors can't fully access it. Lesson 1. What Philip Fisher actually said about concentrated bets. Philip Fisher's 1958 book Common Stocks and Uncommon Profits is one of the most quietly influential investing books ever written. Warren Buffett credits Fisher with teaching him that paying up for truly exceptional companies is often smarter than buying mediocre companies at low prices. Fisher had a 15-point framework for identifying these exceptional companies. Among the most important, does the company have products or services with significant growth runways? Does management have integrity and treat employees well? Does the company have a sales organization that can sustain growth? Does the company maintain meaningful R&D spending? Is the company's profit margin protected by genuine competitive advantages? Now apply this framework honestly to MANGOS. Nvidia. Fisher would have loved Nvidia in 2024. Genuine technology moat, enormous R&D, sales organization globally dominant. But by mid-2026, with the stock having multiplied many times over and competitors finally launching real alternatives, Fisher's discipline would urge caution. Buying late into a story everyone already believes is dangerous. Meta. Fisher would have respected the AI investments and the social network moat, but he'd ask hard questions about ad revenue concentration and competitive threats. Amazon. Fisher would have admired the AWS business, but he'd note that the retail division is increasingly margin pressured. Google, Fisher would have asked the most important question in 2026. Is search still a durable monopoly when AI assistants from competitors are reshaping how people find information? OpenAI and SpaceX, Fisher wrote about public companies. Private companies were not part of his framework. The lack of public financial transparency would have made him deeply uncomfortable. Fisher's discipline was built around being able to read audited annual reports, walk into company offices, ask probing questions of management. Most private market exposure today doesn't allow that. Lesson 2. The history of acronym-driven investing. Here's something most finance creators won't tell you. Acronym-driven market themes have a brutal history. The Nifty 50 was a list of 50 supposedly bulletproof US growth stocks that dominated investing thinking in the late 1960s and early 1970s. The story was, these companies are so great you can hold them forever regardless of price. By 1974, most Nifty 50 stocks had fallen 50 to 80% from their peaks. The FANG acronym, Facebook, Amazon, Netflix, Google, was coined in 2013. It worked for nearly a decade. By the early 2020s, two of those names, Facebook renamed Meta, Netflix, had significantly underperformed the broader index for stretches. BRICE, Brazil, Russia, India, China, was the dominant emerging markets acronym of the 2000s. By the late 2010s, Brazil and Russia were no longer credible high-growth bets. The pattern across history is consistent. Acronyms work brilliantly for several years. Then they don't. Lesson 3. The risk MANGOS specifically hides. Here's what I think most coverage of MANGOS will miss. The acronym actively encourages narrative concentration. When investors believe a small group of stocks will drive most market returns, they pour money into those stocks regardless of price. This pushes valuations to extremes and creates structural fragility. If even one or two names in MANGOS underperform, the entire narrative breaks. And once a narrative breaks, the selling can be brutal. In 2022, Meta dropped over 75% in less than a year when its growth story cracked. In 2025, Apple lost over $1 trillion in market cap in months when iPhone growth stalled. The same dynamic could hit Nvidia, Amazon, or any MANGOS name. Fisher's discipline would say, owning these companies in a diversified way is fine. Treating any acronym as a guaranteed strategy is dangerous. Lesson 4. The private company problem. The most under-discussed risk in MANGOS is the inclusion of OpenAI and SpaceX. These are extraordinary companies. But here's what most retail investors don't understand. Private companies have far less public scrutiny. Their financial disclosures are limited. Their valuations are based on the last funding round, not on continuous market pricing. When a startup goes public, the gap between private valuations and what public investors are willing to pay can be enormous. Many high-profile companies have lost 60 to 80% of their value within a year of going public. WeWork dropped over 90% of its peak private valuation. Snowflake fell over 70% from its peak. Coinbase fell over 80%. Some of these companies recovered. Many didn't fully. Including private companies in a stock market acronym creates a marketing illusion that these names are equivalent to publicly traded businesses. They are not until they go public, and frequently not even then. Lesson 5. What Fisher would actually do today. Based on Fisher's actual framework, not what people imagine, but what he wrote, here's what I think his honest 2026 take would be. He would absolutely consider holding several MANGOS names. Nvidia, Amazon, Meta, and Google all pass at least some of his 15 points, but he would be deeply skeptical of buying any of them at current valuations without doing the work. Reading 10Ks, attending shareholder meetings, talking to former employees. He would refuse to comment seriously on OpenAI and SpaceX without audited financial statements. He would explicitly warn against the acronym mindset. Buying based on a marketing label is not Fisher investing. It's crowd investing. And crowd investing is what makes bubbles. Final verdict. Is MANGOS real or hype? Honest answer, both. MANGOS captures a genuine truth about the current US market. AI is reshaping the economy. A small number of companies are positioned to extract enormous value. Nvidia, Amazon, Meta, Google, these are real businesses with real moats. But the acronym itself is dangerous. Acronyms encourage lazy thinking. They turn complex investment decisions into branding exercises. They make retail investors believe a basket of companies will protect them when concentration is precisely what hurts most in crashes. My take: own AI and tech exposure through low-cost index funds and ETFs that hold these names alongside hundreds of others. If you want concentrated exposure to specific MANGOS names, do the actual Fisher work. Read the financials. Understand the moat. Form your own thesis. Don't outsource your investment decisions to an acronym. The Magnificent Seven made investors enormous money for 3 years. It also led to brutal corrections when individual names cracked. MANGOS will follow the same pattern. The names will deliver until they don't. Be in for the journey. Don't be in for the marketing. If this resonated, subscribe to Earnings Per Page. Next time I'm breaking down the new tradwife economy, trend that just went viral on Bloomberg, and what it actually means about American consumer culture. Drop a comment with which MANGOS name you think is the most overvalued right now. See you in the next one.